Yeah, hey Bill, I called you today because I wanted to talk to you about something. We've been doing this for what, 16 years now?
Yeah,
Yeah.
16 years.
And we've gone through an evolution of change. When we first started, we were doing that first lien HELOC thing, and everybody started copying us. Really, you see a lot of copycats out there, and that's really all they're doing now is a first lien HELOC because they haven't evolved. And I kind of think that they haven't talked to as many people as we have, because if they had the experience that we've had, they would be doing something other than just first lien HELOC. What would you say about that?
I would say you're 100% correct because if you and I go back into the archives, when did we really discover that the two loan scenario, what we call our professional blend, we discovered it after the bubble blew up the last time. Because remember, we were first lane HELOC guys for the first few years, and once that bubble blew up and we started getting phone calls, we realized, we see a problem,
Yeah.
a flaw, and if you recall, that's where we came up with the two loan scenario. And I think, me personally, I think I've done maybe two or three first lien HELOCs in the last 4 years.
Yeah, we can
And
dive into the science of that. And one of the reasons I wanted to talk to you today is because I'm seeing another kind of ripple in the universe, if you will, with the first lien HELOC scenario. Rates are rising again, and if you recall, we started doing this when rates were at 8.25, and we were getting people out of 4% and 5% loans because it still made mathematical sense. But I wanted to talk to our audience, the people that we run into every day, the dated everyday guy that's got a mortgage, and maybe he's in a really good 2% loan. He got a VA loan back in 2010, 2012, 2015, and he's good. I want to talk to the guy out there that's check to check, and he doesn't know why. I want to talk to the ladies and the gentlemen out there that are thinking they're doing okay because they got a low interest rate, but they know there's something different. And we can sit here and talk about rate. People who chase rate, low rate, low payment. Yeah, that's smart, but it's not the smartest. And I in this conversation, I always want to be thinking about who we're talking to, because we can sit here and pound our chest and blow smoke and high five each other because of all of the great things that we've done for thousands of people. But I want to appeal to the people right now because there's another transition that's going to take place, and I don't think a lot of people are ready for it, and they need to be. If you want to be lean, liquid, and independent, this is the video audio you want to watch and listen to, because I'm going to help my partner and I help you win through this big transition that's coming. And so I'm going to ask my partner, Bill Westrom, and I'm David Wells. I'm the CFO, COO for Truth and Equity, and Bill is the CEO with Truth and Equity. We've been doing this for 16 years, and we want to get something out there that attracts people's attention. And, everybody's heard about the first lien HELOC, pay your house off 5 to 7 years. We started that, and now there's a bunch of people doing it, and we've gone beyond that. So we want to talk about how we can help just about anybody, whether you have a home or not. If you make an income, this will work for you. Would you say that's right, Bill?
100%. That's what
So
we've discovered after all this time, that this isn't a HELOC strategy. It's not a mortgage strategy. It's a banking strategy, flat out.
right.
And it focuses on the use of money. It doesn't focus on interest rates. It doesn't focus on a lot of stuff. It's the number one focus, and it's probably the hardest thing that we have to teach people and help them get to understand it. It's all about the income. What's it doing?
Now, do you have a scenario where, and we're going to try and do a few scenarios that people can relate to. That's my goal today. We may not be able to do every single thing out there, but we just want people to understand that, if you earn an income and you have bills, this strategy, which Bill calls credit line banking, will work for you. You don't need to own a home. We like working with homeowners because we can do a lot of fun things, which we'll try to get into on this within this video. But if we don't get to it, then we can certainly get to it in a conversation, because you can always schedule a call with one of us or one of our people, and we'll have that conversation. So whether you're just wanting to get out of debt, you want to do better than what you're doing, you want to invest in real estate or crypto or gold or whatever. If you want to start a dog farm like my niece did, we helped my niece. She bought property and now she raises bulldogs, AKC bulldogs. So, whatever your goals are, we're going to help you get there. So I thought, Bill, if you don't mind, can we address a couple of things? The first one I want to talk about is that guy that thinks he shouldn't get a HELOC because he's in a 3 or 4%. And he's afraid that if he gets a line of credit, at 10 or 11%, why would he take on another debt to pay off a debt? Can we touch on that? And do you have a scenario where we can touch on that?
Absolutely. We've got lots of scenarios.
And bring that up on your screen. I think there's a gentleman who got an 11% personal line of credit to augment what he's doing. Is that?
Yeah.
Let's talk about that guy. And don't worry about personal information showing up. I'll blur that out once I edit this. So.
Okay. Do you want to look at his PB or do you want to look at his statement?
Let's look at a PB and talk briefly about, where he was when you met him and how you got him to where he is and now where he's at. Does that make sense? The 3 phases, I call it.
Yeah. All right. Julian Dawson, let me pull him up. You're recording this?
I am.
Okay,
and
cool.
I may or may not use this, but I'm speaking as if this is the final run and I can edit stuff out. Or I may not. This is a conversation between 2 people who are trying to help other people. And, if it looks raw and unpolished, I don't care. I don't care. This is life.
Hold on. Do you want to start at the profile or you just want to go to the PB?
I don't care where you start. Look at the profile. Tell us where he was when you met him. Take us through the evolution of where he was, what you did, and where he's at. I think. I don't know.
Okay. Well, I tell you what. All right, David, let's look at Julian Dawson first. Julian is a great guy. He's out in Georgia. He works for a booze distributor. He's got a family, Carolina, a couple of kids. Great guy. But this is where we started with Julian, as we start with everybody, your monthly personal economic profile, because we need to see your budget today before you met us, and so we can get a good look at all the puzzle pieces and see where you're at. So this is where we started with Julian and just picked up all his debt information, his first mortgage, and he had a car loan over here to the right. And I won't explain how we broke this all down, but he owed $21,677 on a vehicle and with a $402 payment. And he's got a really good loan. He's at 2.5% on a 15-year with $1,000 payment.
So it really wouldn't have made sense to go to a first lien HELOC, refi, pay a higher rate, and all that bull.
Oh yeah, no. I right from the beginning, I told this guy, you couldn't take that loan away out of my dead fingers.
Right.
Nobody could ever get me out of that loan. So we're going to hang on to that. And the reason why, so everybody understands, is we've got 140,000. That's a decent 6-figure number that's protected under the 2.5%. There's no reason to change it. We can keep that protected, maintain that payment. So this big number is never susceptible to the variable rate. Most important thing.
Okay, and I want to point something out, and you highlight it for me before you change pages. Look at the top. What does it say? Estimated payoff.
5 years, 7 months.
And now that's if he did have a first lien HELOC in his current situation and did refi. We wouldn't know what the rate is. We can't quote rates, but that's pretty aggressive in this environment if he were to do a first lien HELOC. But you didn't take him that direction, I'm assuming.
No, we did not go that direction.
Okay. Well, this will be interesting.
Not at all.
Let's see what happens here. Go.
All right. Now I'm going to retract. I'm going to break this down a little bit because he had the Highlander, right? And we started him off on an unsecured line of credit before the HELOC, just so we can get started quicker. Because
now explain that to me for a second for people who might be watching this. You started out with an unsecured line of credit, so you didn't do anything with his first loan And then you got them an unsecured. Explain that. What is an unsecured line of credit? What is that? I'm sure a lot of people know, but for those who
An
may not.
unsecured. Okay. Well, a HELOC or a home equity line of credit is a line of credit secured by your home. An unsecured line of credit has nothing backing it except your good name and your good credit.
So like a personal line of credit or just a
Yeah.
signature loan, some people call it.
Signature loan, there's all sorts of names for them. But the
Okay.
bottom line is, because, my conversations all the time is, we focus on the line of credit, HELOC or otherwise. We just need one.
So I walk into a bank and I say, I want $20,000. Here's my signature. They're like, oh, you got good credit. Here's 20. Boom.
Yeah,
Okay.
pretty much. As long as, because again, there's no appraisals, it's a strictly credit and income.
Are those easier to get than like a second lien HELOC on a house? Is that easier to get?
I wouldn't say easy. I don't think it's easy to get any loan unless you've got great credit and you're an A+ borrower. That makes it easy.
Mm-hmm.
When we got Julian started back in mid last year, we were looking at 8 weeks to get a HELOC done.
Yeah.
And Julian didn't want to wait 8 weeks to get his HELOC. So we started with an unsecured line. And the only difference between a home equity line of credit and unsecured line of credit is one's secured by real estate and one's not.
Yeah.
And one has a higher interest rate than the other.
Okay.
Because
we'll
the
probably
lower
get
rate.
to that interest rate, but continue on with
Yeah.
this Highlander breakdown because I keep interrupting. I'm sorry.
Okay, no, that's okay. All right, when we started, this is what he owed, $21,677 on his Highlander with a $402 payment. Now, the reason I've broken these two down is that we only got like a $10,000 unsecured line to start. So what we did is we took $7,500 of it and he paid down the Highlander, right?
Mm-hmm.
And then once we got the HELOC and we had more money, he just wrote a check for the remainder.
Okay.
All right. Now, what I do with some people, and you may not even know this, David, but because he couldn't pay the whole thing off, the 75 went in. I had him go and refinance
For a lower rate
that
or for a
payment.
lower payment. Yeah, that makes sense.
For a lower
kind
payment.
of recast
So-
the payment on the remaining balance.
Exactly.
Right, which is smart because
Word.
what does that do?
Well, what it does, it reduces outflow to others and it increases cash flow to the line of credit.
Bingo.
So
it increases cash flow. It's like getting a small raise.
Exactly. Without having to ask for it.
Okay.
And
That's something
so-
that I know our competitors don't look at, and they can't because they don't have the tools. And not to throw my competitor under the bus, but I just got to point out this is the differentiation between Truth and Equity and some of these other first lien HELOC, I call them carnival barkers, are selling. They're selling a first lien HELOC, and they're telling you can pay off quicker, but they're not drilling in on some of these nuances. So I just want to, throw some sunlight on that.
Well, and it's a good point to bring up because I tell people in the initial call and I tell them on the first day after they've joined us, my one and only job is to improve the month end cash flow, because the bigger that number is, the faster we're paying off whatever we have in that line of credit. And so every recommendation I make moving forward is only to improve the cash flow moving into that line of credit. As I say, credit line banking, we're teaching you how to be a banker, and bankers retain and control as much capital as possible. And that's what we teach, and that's what I do for my customers.
That's why I say lean, liquid, and independent. Liquidity is critical. The more liquidity you have working for you, the leaner you can be and independent from, the debt structure. You're just keeping more of what you make and using it to your advantage. But go ahead. I'll stop using this.
Yeah, well, no,
buzzwords.
you're bringing up such an important point, especially now with the economy. You're just getting crushed. And 100% of the people need to understand credit card payments, car payments, student loan payments. These consumer debt payments crush your cash flow. The payments on debt is more detrimental to your budget than higher gas prices or higher milk prices. These things have to go. And what I tell everybody, We don't need their help repaying debt. And that's the whole point of Truth and Equity and what we do as far as a service. Teach you how to be your own banker. You don't need these people's help. If you've got the money, you know how to make payments. You just make them to yourself in your HELOC that you control. Owning and controlling debt is the best way to finance your life because you're in control of the terms of repayment.
Right. And so to recap here, you paid a portion off and then you restructured it with the bank to get a lower payment so you're cash flowing that difference.
You got it. Now, let's take a look at what that looks in amortized form. Our professional blend amortization.
Now, professional blend, what do you mean by that?
Well, we're blending two loans together.
Okay,
like
so
what we just saw with Julian. We're hanging on to his first. We're going to get a HELOC and we're going to blend the two together to work together to accomplish the debt-free goal.
Okay, and now, because I've had this conversation, I'm sure you have too, is, some people would say, well, why would I take on a debt to pay off a debt? When you look at things two-dimensionally, they're right. It doesn't make sense. But when you add the third and fourth dimension, which you're going to show us here, how that works, I just want to, I understand the audience right now, and I'm thinking like the audience. Well, why would you take on a debt to pay off a debt? You're going to show us right now.
Yep. And my explanation of that without visuals is going into debt to get out of debt is impossible. There's no mathematical equation to prove that that is possible. So you can't go into debt to get out of debt. Mm-hmm. What we do here is we add a credit instrument as a working tool within our new structure.
Right.
So we're just using the new debt, the new line of credit, HELOC or otherwise, as a tool to accomplish our goal on our terms instead of playing their game.
And just as a matter of interest at the top there, I noticed it says 5 years and 2 months. So we got a slightly better payoff using this strategy versus the payoff that was first quoted in the profile, which is based on an algorithm using just a first lien HELOC. Now we got a little better payoff with this new professional blend.
Yep, precisely. And that's why, those results being better than the first lien, if you recall, we go back in the Wayback Machine 10 years ago, and, just through our model of analysis, continual analysis, that's when we discovered first lien versus two loan scenario. The two loan scenario is safer, mitigates risk from the rate standpoint. You get a faster payoff, and I guarantee you'll pay less interest in a two loan scenario than you will in a one loan scenario. Even if the payoff is identical, the two loan scenario will perform better than the one loan scenario 9 out of 10 times.
And I'll ask you this, if you agree, it's easier to get into and sometimes less costly because of no closing costs or what have you. It takes less time, less cost.
Well, time is all relevant to what's going on at the bank. And, like right now, you can get a loan done in 3 weeks, 2 weeks, when a year ago it was taking 8 weeks. So, but I know there's a lot of conversation out there about, second lien, the first lien is safer because it's in first position, and that is a fallacy, right? If you default on a loan, you're screwed one way or the other. It doesn't matter if it's first, second, or third lien. So that's a big fallacy. But when it comes to cost, definitely with a second mortgage, if you're paying fees for a second lien HELOC, you're at the wrong bank.
Okay. And now what about an unsecured? Is that a little quicker generally than trying to go through underwriting on a secured loan? Typically?
Yeah, that's a 5 to 7, 10-day process. Okay. And that's one reason that we did that with Julian, because we didn't want to wait 8 weeks to get started. So we got the unsecured line in like 5 or 7 days. We got going. And that's a good segue into, let's look at his first month, July 2001. And what we're looking at here, this is the only one of its kind on the planet. You know as well as I do, Dave, but I'm talking to the listener. This is a proprietary two loan scenario or amortization table that we developed. So what we have here is our first mortgage data underneath that column heading to the left of this little black line. And this is just standard amortization of his first mortgage. You know, we've got his opening balance, we got his opening interest rate, we got the full P&I payment, and then the division of principal and interest. Now, and this is another reason we kept this loan. If we break down, look at the interest compared to the principal. I'm not touching that. You know, most of his payment, look at almost 3 times his payment is going towards principal, or his interest payment is going towards principal. It's a great reason why we never touch that loan. Now, if we come over here to the HELOC side, this is where your truth and equity credit line banking life lives. And so you can see here's that opening balance I showed on the profile, 7,500. That was our opening withdrawal to pay down the Highlander. But look at this interest rate. He was at 9.74. I think I mistold you. I thought he was 11 earlier, David, but 9.74 is where he started. And just by, I'm not going to go through all the column headings and all that, but just through the money flow in and out, he had that $7,500 paid off in 3 months.
Now, mathematically, and you know, it's because I have a little bit of insider knowledge about how this thing works. I noticed the monthly expense column, and you just said you're not going to drill into this, but I got to ask, how do you account for the drop in the car payment when you've paid it down and he refied? At what point in the timeline are we going to, can you address, and am I getting ahead of you and myself here? I'm assuming that when he paid down principal on the car, his payment went down after he restructured the loan. Is that correct?
Mm-hmm.
And then at what point, because the expense column shows the same expenses, I see a drop around the 11/20/21 time frame. Is that where that changed? Now he's cash flowing $400 a month more?
Exactly.
Okay.
Right.
All right. I got
Right.
ahead of you. I'm sorry. I should have waited.
No, that's okay. Because as you can see, if we go month, we had the unsecured line for 4 months,
Mm-hmm.
and then it dropped to 5.25. That's when we got the HELOC.
Gotcha.
Right. And so if you come over here a little farther to the right, you see this 12,430 miscellaneous withdrawal.
Mm-hmm.
Right. Well, that was the final check to pay off the Highlander. So once he paid the Highlander off, he took control. He basically took ownership of the debt. The debt didn't go away. He just changed creditors. He's now the creditor. And when you see the expenses drop, the $402 monthly payment went away. So it came off of this. This was with the Highlander payment. This is after we paid the Highlander off.
So basically, you started with a PLOC because you could get started right away, personal line of credit, unsecured, operated it for a time frame. As the scenario for him got better and allowed him to do something better, you transitioned him into a HELOC, a home equity line of credit. Interest rate dropped. Payment for the vehicle went away. He increased his personal cash flow by $400.
You got it.
Okay.
And what it did, I mean, all we did is we just increased the amount of money flowing into that HELOC.
Okay.
Now, since we're looking at this, and for everybody else, we see this miscellaneous withdrawal. Well, first and foremost, just so everybody understands, you know, all these numbers are live running numbers, right? This is a living and breathing animal, and part of our service, right, and our guarantee is that we track and manage this for you, live data from your statement. And so we track and manage your progress. And so when you see all these crazy numbers in here, this is just input, live input of a live living truth and equity customer. And, you know, some of these miscellaneous withdrawals, you know, I've got notes. I could probably tell you what all these are for, but I know this one, this 5,500, he pulled that out of his line of credit and invested in some property with his parents down in Colombia. And so, you know, again, you don't have to stop living. This is not a sacrificial program. There's no budget talks or nothing. The numbers go in and the numbers go out, and we just track and manage as we move along. Now, as we scroll down here a little bit, 9/21, we took on the debt from down here, August, we took on the debt from the Highlander. That was in October, and he had that paid down to zero by March. So we had a $21,000 car that's paid off in 10 months at a much higher interest rate than what even the car was. And Julian never balked at rate. He didn't care.
Right, because
He
rate
never
doesn't.
talked about interest rate.
Yeah, because rate doesn't matter when you have the ability to mitigate principal more effectively.
It's all about the balance. This is what costs you the money, right? Because even after just a couple months in, he got it down to 110 so fast. Because this is I think he brought some savings in. But, you know, when you're down to 110, 9.74, who cares?
Yeah.
Nobody cares. Because we're balance driven. We're looking to get it low, 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 low. And of course, that's all we focus on, get it to zero. Now, what happened once we hit zero? Because if you don't have a balance in the line of credit, the program stops, right? Because you can't put money into a debt that you don't owe money on. So what did we do? Well, if we look at this column here, this is withdrawals to first mortgage. So what we did, and by this time we had a $100,000 line of credit, right? That's the HELOC credit limit.
Right.
And so we took 20 grand. And if you follow the cursor over in the principal column, you see this big $20,000 drop. So we went from 134 down to 113. And so 20 grand. Now he had a really good month and got it down to 13.3 by the next month. And we just keep money in, money out, wash, rinse, and repeat. Now here's something interesting for you, because this is right in the middle of rate increases. Went to 5.5, couple months, he's already at 6 3/4, 7.25, right? But you know what? We don't care.
Yeah, rate doesn't
because
matter.
we're balance-driven individuals. Balance, 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 balance. Because if you want to save interest, the fastest way to save interest is pay off the debt.
So you've
It's not by
abandoned
chasing
using
interest rates.
you've abandoned using the checking account in traditional fashion, and you're using the HELOC as your checking account. Basically, everything you make goes into the HELOC rather than the checking account. Or, you know, you have to get it to checking first, then move it to HELOC. But nothing stays in checking because it's a stagnant pool.
It's got no value.
Right. Okay.
Because the beauty of it here, because if you put your money in, the HELOC rate is your savings rate. Because if you paid it down with your whole paycheck, well, that amount of money won't be charged 7.25 or 7.5%. And here's a little thing that most people won't be able to teach you out there. You want to know how much you're going to save? Multiply your paycheck by the interest rate, divide by 365 days, and multiply, and that'll tell you how much interest per day your paycheck will save you. Right. And it's an astonishing number once you look at it. But I need to correct something from you. As far as use the HELOC like a checking account.
Yeah, and I don't mean in and out, daily. I mean, don't leave anything in checking when I say that. Yeah. Don't leave anything in checking, but don't use it like a checking account. Just treat it as your depository instead of, the
well, I teach
account.
People, look at it like a vault, because we are going to use the checking account traditionally when it comes to receiving income and paying bills. Mm-hmm. The line of credit is just the stopgap vault where you throw your money. So you depress the balance and save interest.
Yeah.
That's what your income, that's what your income's going to be doing for the month, is a savings, an interest savings mechanism, because we know we're going to have to pull money out for bills.
Yeah.
And that's where we differ more than anybody else, because you don't treat that HELOC like a checking account. You don't spend money out of that thing, because every time you ding it, you're going to pay interest on your coffee and your milk and your bread. You're going to pay interest on everything. And that's why our service, implementation service, is so important, because we help everybody get everything to one day, get everybody in a single file line. And the reason, so when it comes time to pay bills, the money comes back out of your vault, the line of credit, back to a checking account for everybody to come get their money, because that's what they expect. They get paid out of a checking account. So we'll make sure the money is there. And whether it's manual or the checking account and the HELOC can talk to each other, that's part of our service, is to make sure we get the right loan for the job. But again, the money flow or the checking account's going to be used traditionally from receiving income and paying bills. But between payday and bill payday, that money's going to sit in that line of credit, saving you interest every minute of every day, because that's the most efficient way to do it.
Next thing, I had a question. As it relates to bill pay, what is one thing that you see that's pretty common with people who have a cell phone, water bill, electric bill, credit card, maybe a couple, few? Some people don't have credit cards, but most people do. I mean, what are you running into with, how people have their bills pay dates structured?
Oh, it's all over the board.
Meaning
You've got some people that they're paying bills, they got everything set up, so they're paying right out, on paydays, so they're paying bills twice a month. I've got some people that chase stuff around every day. Literally every day they're jumping into their account and they're paying a bill here, blah, blah. It's all over the board, David. There's no standardized way that everybody's operating their finances.
Ideally, is it possible to have like one bill pay date or maybe no bill pay date because things are just automated? What's dangerous? What isn't? I'd like to explore this whole bill pay structure, because me personally, I find what you said, the latter, people's bill pay is like they're paying bills 15, 18 times a month. I mean, are you nuts? What are you doing? Well, everything's due different days, so I pay them differently. I'm like, yeah, but so what are you finding out, and what are you doing different?
Well, I want to make a comment on, your familiarity with people doing this all the time and why. Mm-hmm. I'll tell you why. Because people feel like they're a subordinate to that statement and to that company. Oh my God, I owe the money. Oh my God. The ink on the paper is directing their lives. It's due on the 15th. It's due. I have to pay that bill, because their budget and their finances are being run on everybody else's terms, their due dates. And most people, they're flabbergasted to even think that they could change a due date. And I haven't done, every customer. Now,
what are you finding are the easiest pay dates to change? And then what are you doing with people who can't change? Like, I know the electric company's not going to send the driver out on a different day for you so they can send a different bill a different day. That's pretty much immovable. So what are you doing with the immovables, and then what are you doing with the movables?
Well, with the movables, we pinpoint the bill pay day, and the bill pay day, it's as unique as everybody else. I can't tell you exactly what your bill pay day would be, because I haven't looked at all the puzzle pieces of your budget. And so that's, again, part of the implementation process. And we've got forms that we have people fill out so we can see it all in one place. And then once we discover those that we can move, then we're moving them to that bill pay day. Yeah. And let's just say it's the 14th of the month. Now, when it comes to utilities and those people that won't play ball with us, because sometimes people won't play ball, then, there's certain policy, certain procedures that we can do to make sure that when those people come to get money, they get their money. Because I always tell everybody, the most important thing is people getting paid. And, again, that's just the bottom line. So again, it depends on the structure. Is the HELOC and the checking account connected, or does it require a manual move? Again, there's so many variables to give a definitive answer today. But again, that's part of the implementation process, is to be able to look at it all and know what we can and cannot do, and then strategize and make recommendations accordingly.
Yeah. Now, one of the things I've experienced, and take a little bit of time to throw some of these other folks out under the bus. There's this software program out here. The software does all that for you. And it's kind of this mystical background thing that's, timing the bill pay dates. And it's just basically alerting you to something that you already know. And to me, it's a big distraction. The ideal thing that I've found in my experience is moving everything towards an immovable pay date, like the electric bill. I'll get everything due and payable on that day. Or I'll instruct people to pay their electric bill with the credit card, let it auto pay, because that's a movable thing. The credit card is a movable pay date. So you can move that credit card and absorb that immovable pay date. So there's, like you said, there's an examination that takes place, and we figure out the best way to have one pay date, whether it's automated or manual. So you're freed up 29 to 30 days out of the month.
Yeah.
You're
And
freed
one
up.
thing I do tell people, when we get those people that won't play ball with us, okay, we got to deal with it, and if it's not coming out on bill pay day, maybe a couple of days before or after, what have you, whatever little bit of interest that we're going to get popped with, it's not going to slow us down. It has no bearing on performance. It is what it is.